Good morning. Delighted to be here. I think this was quite eye-opening. Incidentally, we are listed on the London Stock Exchange, so the previous discussion was just made me think that perhaps we could claim some endangered species subsidy. We'll see, something to think about. I also quite like the theme for this year's summit, Revolutionaries. It's quite provocative, or at least thought-provoking. And we've already heard it. I'm also quite curious to hear how all the speakers will weave references to revolutions, I don't know, Che Guevara or the guillotine, we're talking about the French Revolution, in their speeches. We'll see, should be interesting. For sure, changes in the asset management industry will be discussed. Some of them are quite significant. And what I thought I would do through these opening remarks is share some thoughts as to what I think at least some of these changes mean for the industry. ICG invests and manages funds across a number of strategies and geographies, so it's a reasonably good observation platform for this. And if you look at what we've been observing and experiencing, I think what we're really seeing, and there's a big hint in the title, is a maturing industry. It's an industry coming of age, and there's a lot of evidence of that, and I think you're going to hear a lot of evidence and signs of that throughout the day, but we could take many, but we could take a few. If you think about the increase in regulation, at least part of that is actually both a consequence of and a contributor to the maturing of the market. You could also think about the structural increase in LP allocation to the asset class, which is accompanied by much greater sophistication and product differentiation. That's also a sign of a market that is maturing. But I'd like to focus on two current developments which we've been able to witness firsthand because we've taken some part in both. One is in the direct lending space in Europe, and the other one, less visible, probably because much nichier and more recent, is in the development of a niche subsegment of the secondary space in providing liquidity on single funds, which is sometimes, I think, erroneously referred to as fund restructuring. And both illustrate my point about a global alternatives asset management market coming of age. On the senior direct lending front, a lot has been said, a lot has been written. You can take pretty much every metric. They're all impressive. So I've just picked one. I think it's from Deloitte. There have been more than 1,000 transactions closed in Europe in direct lending over the past 5 years. So that's more than one every 2 days. And for an industry that didn't exist pretty much before then, that's quite impressive. In fundraising, I think it's already clear that this year will be a record. Certainly our own experience has been that there's very, very high demand. So it's a very popular strategy experiencing very significant growth. But there's a recurring question, a recurring theme about direct lending, which is, could this opportunity disappear as quickly as it's emerged? And that's a legitimate question because if you remember, it's not that far back, but it's a few years back, if you remember, the original pitch for direct lending was very simple. It was market dislocation, the banks are retrenching, that creates an opportunity for direct lending. And this was largely true, except it was really focusing on the catalyst, not on what was actually a structural change in the market. Because if it's just a market dislocation, well, then it should follow that as soon as the banks have mended their balance sheet, everything will go back to normal and the banks will take back their original market position, which is not what's happened. And if you think about it, most European banks are in as healthy a position as they've ever been. Actually, on average, I think the Tier 1 capital ratio has pretty much doubled since 2007. I think it's around 16%, which is higher, by the way, than for the American banks. So by and large, European banks are healthy. If they wanted to significantly get back into the space, they could, and they haven't. And the reason for that is the market is maturing. The market is specializing. It's becoming more efficient. If you think about it, a long-term loan that's going to be liquid to a mid-sized company is much better suited in a long-term closed-end fund than on the balance sheet of a bank, where it's going to create an asset and liability mismatch. And also the banks have, well, they've known this for a while, but they've realized that the bulk of the profit they were generating in the space, they were generating in ancillary services, not in the holding of those assets, of those loans. They were generating them through cash management, through hedging, for the larger companies at some point through some bond issuance, but it's through the ancillary services that they were really generating profit. And so what's happening in this market is, yes, there is still competition between banks and private lenders in some instances, but actually fundamentally they are more complementary. It's just the market is specializing, and market participants are focusing on the areas where they have a competitive advantage, areas that they're better suited for. So that's direct lending. I mentioned another example, another point, which is in the more exotic secondary space, and a niche part of that, which is quite recent. But over the past few years, there have been a growing number of transactions where a secondary investor, sometimes a specialized secondary investor, has been providing liquidity to LPs into a single fund. Right? So it's almost the reverse of a traditional secondary investment. Traditional secondary investment is a secondary investor is buying a group of commitments and investments into various funds from one LP. This is buying the exposure of all LPs into a single fund. And it's often referred to as fund restructuring because initially this started in situations where there was an underperforming fund and the LPs were desperately looking for a liquidity option. But the market has already moved on, and we've already started to see a number of transactions that are now being made on performing funds. Actually, there's been some press news recently about potential transaction on an Apex vintage and a Nordic Capital vintage, and there's been news about BC Partners having done such a deal not too long ago. So the market is clearly broadening, and why is that relevant? Apart from the fact that it's intellectually interesting and it's a new niche strategy, so it's always exciting. Well, it's interesting because it reflects greater sophistication of the market. The market is becoming extremely sophisticated to the point where you're now finding liquidity options for investors even in more complex situations. Okay? Which is interesting for the industry as a whole, by the way, because the usual trade-off for alternative investment was you're getting a higher return. The flip side is there's no liquidity. Well, that's no longer true, or it's less true, certainly, than it was. In many instances, you can find liquidity, which is likely to make the asset class even more attractive. So if you think about this, and if you accept that there's enough evidence to show that our market is actually reaching some level of maturity, that it's coming of age, there are a number of implications, because any market that is maturing is displaying some common characteristics, and we've mentioned a few. There's a greater specialization. Clients in our industry, investors, are becoming more sophisticated. They differentiate more between market participants, between products. They're becoming more demanding as well. You are likely to see more regulation because a maturing industry is becoming more visible. You could see consolidation as well. That's typically what you see in an industry that is maturing, as well as the emergence of innovative niche strategies. I've mentioned one, there will be others. That's also a feature of a maturing industry. And finally, it's quite comforting because at a time when we're all wondering, when is there going to be another cycle? Is there doom tomorrow? Trying to read through market changes, whether there are indications of impending doom. Well, I would point to the fact that a number of the changes that we are seeing in our market They may generate significant challenges, but they're really a manifestation of the fact that our industry is maturing. And that's a normal evolution. It's a normal stage of development for any industry. It's actually a sign of health. So on that positive note, pass the floor on.